Hey everyone, welcome back to the Web3 Daily, and let's break down what's happening in the markets today. Honestly, the market is sending some interesting signals right now. If you look at the big picture, the total crypto market cap and trading volume have actually dipped a bit. It seems like things are cooling off. But when you zoom in, you see Bitcoin and Ethereum, the two leaders, showing some serious strength. Bitcoin's dominance, in particular, is on the rise. What does that tell us? It suggests that in this uncertain market, the money is getting smarter and a little more cautious. People are pulling capital out of riskier altcoins and moving back into the safety of Bitcoin and Ethereum. It's a classic flight to quality, but it's also mixed with a sense of anticipation for what the top assets will do next. To put some numbers on it, Bitcoin is up over 2%, trading around $111,900, while Ethereum is up nearly 3%, clearing the $4,100 mark. So even though the broader market looks a bit sluggish, the strength in these core assets tells us that confidence hasn't disappeared. It's just gotten a lot more focused. Speaking of confidence, the topic that's absolutely blowing up everywhere today is the bombshell dropped by Wall Street giant JPMorgan. They put out a report predicting Bitcoin could surge to $165,000 by the end of the year. You heard that right? 165,000. My first reaction when I saw that number was, okay, which analyst is just trying to get clicks? But when I dug into their reasoning, I realized this is different. JPMorgan's core thesis is that the market is currently in the midst of a retail-led debasement trade. It sounds a bit technical, but what it really means is that people are losing faith in fiat currencies, especially the US dollar. Inflation, massive government debt, it's making the cash in people's hands worth less and less. So they're starting to aggressively buy hard assets like gold and Bitcoin to protect their wealth. The most interesting part is that JPMorgan specifically highlights that this wave is being driven by retail investors. That's a shift from the institutional bull run narrative we've heard so much in the past. They've observed that since the end of 2024, retail money has been flooding into Bitcoin and gold ETFs. The data completely backs this up. About Bitcoin ETFs recently saw a single-day net inflow of a massive $676 million, with BlackRock's IBIT and Fidelity's FBTC just vacuuming up capital. The significance of this, in my opinion, goes way beyond a simple price prediction. When a top-tier institution like JPMorgan uses its models and credibility to endorse the digital gold narrative for Bitcoin, it carries a different kind of weight. It elevates Bitcoin from a high-risk tech stock investment to a strategic macroeconomic hedge. This shift in narrative could attract a whole new class of traditional investors who previously wouldn't have touched crypto, creating a self-fulfilling prophecy. Because everyone believes it will go up, they all buy in, and as a result, it actually does go up. So, what we might be witnessing isn't just a price rally, but a major market move ignited by retail sentiment, fueled by institutional capital, and given the green light by a Wall Street titan. Alright, let's dive into our first major news story of the day. And this one, I think, could send some serious shockwaves through the payments industry and even the traditional finance world. The American digital bank, SoFi, has announced it's launching an international remittance service powered by the Bitcoin Lightning Network. When I saw this headline, my first thought was, finally, it's happening. So, how does it work? Let's say you want to send money from your SoFi app in US dollars to family in Mexico. Behind the scenes, SoFi instantly converts your dollars to Bitcoin, zips it across the Lightning Network in a flash, and on the other end, it's automatically converted back into the local currency and deposited right into their bank account. The whole process is seamless for the user. You might not even realize Bitcoin was involved. This is the real Trojan horse strategy for Bitcoin. We've always talked about Bitcoin as digital gold, a store of value, but its narrative as a payment tool has been weak because the main chain is slow and expensive. Now, SoFi is using the Lightning Network as its back-end settlement rails, perfectly solving the speed and cost issues. This is the biggest endorsement of the Lightning Network from a mainstream financial institution to date. And what's more, they're using a technology called Universal Money Address, which basically makes your payment address as simple and memorable as an email. No more copying and pasting that long, incomprehensible string of characters. This immediately solves the terrible user experience problem that has plagued the Web3 payments for years. SoFi's move is arguably the first shot fired by a traditional bank using the Bitcoin network as its back-end infrastructure. The significance of this goes far beyond just treating it as another speculative asset. and it's something we need to watch very closely. Now for some regulatory news. New York is once again turning its attention to crypto mining, but this time, their approach is a lot more sophisticated than the old one-size-fits-all bans. They've proposed a new bill that, in simple terms, will impose a tiered electricity tax on proof-of-work mining. So how is this tax designed? It's not a flat rate for everyone. It's based on your scale of electricity consumption.
If you're a small-time miner with low usage, you're fine. No tax for you. But if you're a mid-sized farm, you'll start paying a bit.
And if you're one of those industrial-grade, power-guzzling behemoths, then you're going to face the highest tax rate. It's a very targeted design aimed squarely at the largest energy consumers. But here's the most crucial detail. The bill explicitly states that if you're using 100% renewable energy and you're not drawing from the public grid, you are completely exempt. This is a brilliant move. It's not about eradicating the mining industry, but about using economic pressure to force these companies to transition to green mining. This marks a significant evolution in regulatory thinking, moving away from the crude administrative bans of the past toward more nuanced economic management. This strategy will likely become a template for how other regions regulate mining in the future, and it could completely reshuffle the crypto mining landscape in the United States. Let's shift our focus over to Europe and check in on the latest with central bank digital currencies. The European Central Bank just took a major step forward with its digital euro project by officially announcing a list of technology service providers. What does this tell us? It means the digital euro is no longer just a concept in PowerPoint presentations and research papers. It's now moving into the actual technical implementation phase. If you look at the partners they've chosen, they're all established fintech players like Capgemini and Geseke plus Devrient, not the decentralized protocols we're used to in our space. This clearly signals the path the ECB is taking. The central bank will control the core ledger and the rules, while outsourcing front-end applications and risk management to private companies. It's a classic public-private partnership model, but there's a detail here that's particularly interesting. On the list of partners, there's a specific category for fraud and risk management. This is practically a flashing sign that the future digital euro will have very powerful transaction monitoring and compliance features built in. Of course, this is for financial security, but it also raises a critical question for us. Is a programmable, traceable digital currency issued by a central bank fundamentally at odds with the Web3 ethos of decentralization and censorship resistance? So, on the surface, the ECB is creating a digital euro to improve payment efficiency, but the deeper motivation is really a battle to defend monetary sovereignty. They're watching the current crypto world, where nearly all trading and DeFi applications are dominated by dollar-backed stablecoins like USDT and USDC. If a significant portion of future economic activity happens on these private dollar-pegged stablecoins, what happens to the euro's status, the digital euro? Therefore, is essentially a defensive weapon for Europe to secure a strategic position in the future digital economy. This is something we need to keep a close eye on, because it will help define the relationship between money, privacy, and state power in the digital age to come. After talking about the top-down approach from the European Central Bank, let's switch gears and look at how bottom-up community incentive models in the Web3 world are innovating. The giant of Web3 gaming and the metaverse, and Mocha brands just made a huge move through their flagship project, Mocha Network, by launching a program called Mocha Portfolio. When I saw this plan, my first thought was, this is what Web3 is supposed to be about. We all know the traditional airdrop model. Let's be honest, it mostly attracts a swarm of airdrop hunters who dump the tokens as soon as they get them, which does nothing to help the project build a real user base. But Animoca is flipping the script. They're taking $20 million worth of tokens from their massive investment portfolio, starting with Magic Eden's ME token. And instead of just dropping them on everyone at once, they're making you earn them. You have to stake your Mocha tokens or Mochaverse NFTs to slowly accumulate something called staking power, and then you use that power to claim your allocation of these new project tokens. This is a brilliant strategic move. It essentially transforms Animoca's powerful venture capital arm into a value distribution engine that's open to all Mocha holders. If you hold a Mocha, you're basically holding a golden shovel that gives you a share of Animoca's future investment returns. This completely changes the game. It stops rewarding a snapshot of your past behavior and starts rewarding your future. Continuous participation and commitment. This economic model cleverly filters out the short-term profit-chasing speculators and retains the long-term believers who are genuinely invested in the ecosystem's success. For building a healthy community economy, that kind of model is priceless. Okay, for this next story, we have to talk about the Layer 1 wars, because the strategies are starting to look more and more like something straight out of Wall Street. The Avalanche ecosystem recently kicked off a massive financial play, raising a total of about $1 billion through 2 major deals. So what's this money for? It's not just for simple ecosystem incentives. They're using it to create 2 publicly traded digital asset treasury companies right on the Nasdaq in the US. The sole mission of these companies is to buy and hold massive amounts of AVAX tokens for the long term. When I saw this move, the first thing that came to mind was the MicroStrategy playbook. But what Avalanche is doing here is on another level. MicroStrategy turned its own company into a Bitcoin holding vehicle, allowing traditional investors to get exposure by buying its stock. Avalanche is now being led by its foundation to create 2 such public companies at once. And crucially, this isn't just a simple buy and hold strategy. These treasury companies are also tasked with actively investing in and building out the ecosystem, acting as catalysts for Avalanche's growth. In essence, they are deeply integrating a public company's balance sheet with the development of an entire public blockchain ecosystem. The ultimate goal here is to use the power of the capital markets to gain the same level of institutional legitimacy that Bitcoin and Ethereum have, and to build up a massive war chest for the next phase of the Layer 1 competition. You could call it a brilliant strategy of using traditional finance tools to give a massive blood transfusion to a Web3 ecosystem. Finally, let's look at a piece of news from the world of traditional finance. But this story, in my view, is the ultimate tip of the hat to the native rules of the crypto world. The world's largest financial derivatives exchange, the CME Group, has announced a major plan. Starting in 2026, they will offer 24/7 year-round trading for their cryptocurrency futures products. Now you might hear that and think, so what? They're just extending their trading hours. But if you're an experienced trader, you definitely know the term CME gap, because the crypto spot market never closes, but CME futures do on the weekends. It creates a massive price gap every Monday morning between the futures and the spot prices, adding a lot of uncertainty to trading. Now, CME has decided to completely eliminate that gap, starting in 2026. The deeper meaning here is that it signals a fundamental shift for traditional finance giants, moving from trying to tame the crypto market to fully embracing it. Remember when the CME first launched Bitcoin futures? They were trying to force this wild new asset into their traditional 9-to-5 framework. But now, with this move, they're admitting that the crypto market has its own unbreakable rules. And the most important one is that it never sleeps. This isn't just a service upgrade. It's a fundamental change in their business philosophy. Taking it a step further, the CME is likely positioning itself for the distant future. With the rise of tokenized real-world assets, or RWAs, the entire financial market of the future could very well operate 24/7. The CME is using crypto futures as its testing ground, paving the way for a grand future where all assets are tokenized. Alright, that wraps up today's Web3 Daily. If you found this helpful, please hit that like button to show your support. Every day, we sift through the Web3 world to bring you the most important news that's closest to the money. And we hope that by curating this content, we can help you make more rational and informed decisions on your Web3 investment journey. Also, I've dropped exclusive registration links for major exchanges in the comment section below. These are high rebate offers we've secured for our fans, and we hope they can help you save some costs along the way. Let's all stay rational, move steadily, and get wealthy gradually in the world of Web3. May everyone's crypto assets grow steadily. We'll see you tomorrow.